Good morning, traders and investors. Roger Scott here, Senior Strategist for Wealth Press. Today is Tuesday. It's June 20th. We're finally coming off another 3-day weekend, and you guys know what that means, fragmented trading session. Now, a few things I want to get off my chest. First of all, when I do this morning analysis, I want to make sure you guys understand we're not doing this for day trading purposes. In other words, if I'm telling you that the tech sector is going down, it doesn't mean it's going down in 5 minutes. It means it's looking like it's going down over the next few days or over the next week. If I tell you that I think industrial stocks are going to go up, it doesn't mean it's going to go up in 5 minutes. So if I tell you something is happening, remember, we're not day trading, we're swing trading. We're looking for things to happen over a period of a week or two. So don't take what I say as it's always a micro view, because sometimes it's a macro view. So just want to make sure you guys understand that. Second of all, I want to thank each and every one of you for liking this channel, subscribing to this Wealth Press YouTube channel, and watching our videos and commenting below this video. Thank you for doing that. Now, because this is a fragmented week, because this is a 4-day weekend, we're going to start out slow. There wasn't much federal data yesterday. We're starting off with housing starts and permits, and then we have our best friend, Mr. Jerome, a.k.a. Squirrely Powell, speaking tomorrow. We got Jefferson speaking tomorrow. We got Goolsby speaking tomorrow. We got Mester speaking tomorrow. Then we got jobless claims. Then we have more existing home sales. Then we have more speakers on Thursday. So it looks like there's going to be a lot of Fed speakers, which means we have to keep our eye on the bond market. Now, the bond market right now looks like it's coming off, and without any major decisions over the next couple of weeks, I think we're going to see some upside. So keep your eye on the bond market, especially if we see tech come down. We may see flight to quality. Another thing I want to show you, and this is just something I want to talk about. Right now, a lot of traders are looking for the most undervalued assets. I would say right now, based on what I'm seeing, the most undervalued asset is the volatility. I think volatility is extremely undervalued. And I think implied volatility is not pricing in a lot of drama. And I think we may have a lot of drama on the because we're coming off right now these low levels. And typically when we get into these low levels, we have a spike. And we haven't had a volatility spike in quite some time, as you could see here. So I'm predicting we're going to have a nice volatility spike. And I'm also going to predict that it's going to be coming at the same time that we have more selling pressure coming into the Nasdaq. As you could see here, this is way overdone. Momentum levels wise, if you look at the QQQ as a whole, you've got 87% of the QQQ trading above the 20-day moving average. And when you're looking at that as a whole, just to give you some perspective of where we're at right now, that's not, and I repeat, that's not a position we want to be in very long. It doesn't happen very often. If you look over a 10-year base, let's see, 20 years. 20 years, we've been at this level once, twice, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 16th time in 10 years. So this doesn't happen very often. Actually, in over 10 years, in almost, let's see here, 7. This is going back about almost 16 years. So, or actually about 17 years. So again, it doesn't happen very often that we go up to these levels. And when we do, you got to be really careful. So the fact that volatility is making a very swing low right now, a very swing low, and the fact that we're overbought on technology stocks should give you a pause into what I'm thinking right now, or it should give you a good idea of what I'm thinking right now. So I'm expecting the bond market to possibly go a little bit higher. I'm expecting definite downside from the technology sector. And if you look at most of the sectors in the technology sector, you will see that they're grossly overbought. Let me look at this. Consumer discretionary, 92. Infotech, 88. 92 on a 50-day line. Consumer staple still has a lot to go. Energy has a lot to go. But 92 just doesn't look like there's a lot to go on the 50-day line. So again, be really cautious, especially with these technology stocks. Now let's talk a little bit about what we can expect today. Now the market's opening up. It's going to open up bearish. Now typically when markets open up bearish, they tend to rise, and this is a random number, 114, especially with the 35,000 value. 42, this is not as random, but again, these are, in light of the volatility we were seeing, I want to see how the market goes, but I would be really skeptical to see that the market goes into hardcore positive territory this week. Be careful and watch sell-off. There's not much. Remember, interest rate decisions already on the table. There's not much there, and I don't think Mr. Squirrely Powell is going to get really bullish as we head into this week. Now we have concerns over Chinese economy waiting on risk as well, while investors are looking ahead for Mr. Jerome Powell for more cues on the U.S. Central Bank's rate outlook. And I don't think he's going to sugarcoat it that much. I don't think he has to right now because the stocks, I think they're worried that the stock market's going into mania zone. And honestly, I think tech, consumer discretionary, I think we're hitting mania levels. It's just way too narrow of a rally and it's not sustainable. We got tech-heavy Nasdaq 100 underperforming major benchmarks, pressured by drop in chip stocks after Micron, and I talked about this in my VIP room last week, warned that about half of its China customers' revenue as at risk of being lost. That's not good for chip stocks, okay? Xeon Bank, which is not good for regional banks, dropped another %. I should have shorted that one instead of the entire sector, but here we are. Data on Friday showed that the University of Michigan's gauge of consumer sentiment rose to a 4-month high, and the market still couldn't keep it up based on that. So it's not really great. Their year ahead of inflation expectation fell to a 2-year low of 3.3%, much lower than the expected 4.4%. That's one of the reasons why the market was so bullish last week. Richmond Fed President Barkin said on Friday that the Federal Reserve might need to tighten monetary policy further to reduce inflation and a slow, resilient U.S. economy and labor market. Inflation is sticky, folks. Barkin also cautioned that premature seizing interest rate hikes could potentially result in elevated inflation in the future. They want to get rid of this thing. If you back off inflation too soon, inflation comes back stronger, requiring the Fed to do even more with even more damage, he said, which is 100% true. But meanwhile, Mr. Squirrely's making it sound like everything is fine. We've got about a 75% probability that there will be a 0.25 basis point increase in hikes. I think that's what's expected, and I think that's what's priced in. I'm not seeing it fluctuate too much, but if things get really bad, we may see the number drop to about 40%, 50%. Don't be surprised, especially volatility starts moving. U.S. Secretary of State Blinken held a meeting on Monday with Chinese president and stated that the United States and China have made progress. Yeah, don't hold your breath. In redirecting their relationship back to a positive trajectory, as both sides agree on the need to stabilize significantly strained U.S.-China ties. Yeah, well, when I see something being happening, then I'll believe it. Investors are going to be focused on congressional testimony this week. You better be careful, Powell. You're going to be sworn, under sworn duty, for fresh clues on the Fed's next move. Powell will testify before the House Committee on Wednesday and the Senate Banking Committee on Thursday. That's tomorrow and Thursday. But remember, it's Tuesday today, and it's a fragmented week, which means slow start. Powell's testimony will supplement the release of the Fed's semi-annual monetary policy. Several Fed speakers are going to be speaking this week. I mean, Bowman, Mester, Barkin, Bostic, they're all going to be speaking this week, which will be very interesting to see what they say. We've got building permits today and housing starts tomorrow. Not huge data, but definitely data that we need to pay attention to. In Europe, data on Tuesday showed the German Producers' Price Index rose at their slowest pace in more than 2 years in May. Germany is still not getting it together. China closed lower as concerns over the country's slowing economic growth outweighed interest rate cut by the central banks. And the Bank of China trimmed 2 key benchmark lending rates for the first time in 10 months on Tuesday to shore up a slowing economic recovery. And I'm going to tell you, folks, the world is becoming one. And without China getting their you-know-what together, it's going to be a lot harder for economic recovery to happen globally. Much, much harder. So one of the factors, one of the pieces of the puzzle that we're looking at right now is China. And we're not seeing what they promised us earlier in this year, a very fast recovery from a 3-year lockdown, which I was very skeptical on, and for obvious reasons. Now, earlier this year, I told you that Warren Buffett is making moves into some Japanese stocks. Well, look at this. Mitsubishi rose 3%, lending trading hours higher after Warren Buffett's Berkshire Hathaway said Monday that its unit, National Indemnity, increased its passive stakes in 5 Japanese trading houses to over 8.5% each. Now, I warned you this was happening, And the reason Buffett is doing that is because he knows that the new prime minister of Japan, is going to start increasing rates. He's got a very different agenda than the previous ones. And if he starts increasing rates, it's going to cost him a lot more margin to buy these stocks. So he wants to buy them now before rates go up. I think Japan is in the beginning, the virtually beginning stage of a major financial development. I think they're going to be focusing more on themselves versus the exports and imports, which is really good. China bad news means lower prices for Chinese stocks like JD, PDD. They're going to be opening lower today. You may see some upside in Philip Morris. They were upgraded, and you may see downside in Palantir Technology as they were downgraded. We've got earnings for FedEx today. Keep an eye on that stock. Very instrumental stock in seeing how the industrial market is going. Now, speaking of industrial stocks, I'm not overly bullish right now. Not at all, actually. So you got to be really, really careful. If I were you right now, I would be looking at consumer staples and I would be looking at healthcare. Why? Because they're defensive. Remember, we're going to be talking about interest rates this week. Technology stocks, I mean, look at this. They're really, really overdone. Look at consumer discretionary, look at consumer communication services, and look at technology. They're all on the downtick. I think it's going to continue moving down. I don't think we're going to see more upside. So I would stick with consumer staples, healthcare, and basic materials. Those three sectors. I think you'll be surprised because the money coming out of the tech is going to be going into those sectors. Industrial appears a little bit overbought. So I would be careful till we see what happens. But I like consumer staples, I like healthcare, and I like basic materials right now for the near term. Now, those are the three strongest sectors. Keep your eye on momentum levels on the Dow. Keep your eye on momentum levels on consumer discretionary, which is at 92%, information technology at 88%, and communication services at 83%. And if you look at them right now, you will see it looks like they're topping out. That looks topping out. Consumer discretionary looks like it's already topped out right there. Let me just delete this. Looks like it's topping out, and communication services too. Looks like it's already headed down. So be really, really cautious. Remember, we don't hit these levels a lot. And if these stocks or sectors tend to go down, I'm going to tell you right now, volatility is going to start spiking. And if volatility spikes, it could easily go to 25 from 14. You can buy an option for that right now. I would buy something that doesn't expire for a while. Maybe go up to about 719. You can get right now a 14 call for about $2.80 or a 15 call for about a 2.25. That's where I would be looking right now. You have 32 days till expiration, and I think that's where the money's going to be. I don't think this tech rally is going to sustain itself. There's very high odds that it won't because global economy is slowing down. And if global economy is slowing down and Micron's having bad news, it doesn't look like things are getting any better for chip stocks, and we already have the interest rate decisions. I think this is a huge red flag, what we're seeing right now. This is like big time greed. It's very narrow. It's only concentrated in a handful of stocks. Be very, very careful. And if you look at the QQQ, the equal weighted Nasdaq, you'll see that it's already starting to descend quite a bit right here. There it is here. You can see this is a down bar. It doesn't have that much more to go. I think it's going to go down to its base and then come down. We are coming down big overbought levels. Let me show you the 5-day RSI. Look at that. That's probably the highest overbought levels. Man, I think that might be the highest overbought levels we've seen in... That's the highest overbought levels since we've seen before moving up to the COVID crash. Look at that. So you got to be really, really careful, and I don't think this is going to be sustainable. This is going to be a reversal, and it's going to come right back down, and people are going to be thinking, oh, I should have known better. Be really careful. Now, folks, before I let you go, Wall Street is targeting certain stocks and their options with the next capital injection. And there's a new 24-hour opportunity you need to see before the market closes today. Chuck Hughes and I, we're going live at 1 p.m. Eastern Time. That's right, 1 p.m. Eastern Time, Tuesday. What is it? The 20th. Wow, the 20th. So Chuck is going live at 1 o'clock Eastern Time today. And what could be a look at one stock in particular. Follow the link below, and we'll cover the details later today. Follow the link. If you don't know where it is, go to the YouTube Wealth Press channel. It's below this video. Or wherever you're watching, it's either above or below. If you want to subscribe to my Telegram channel, you could find the link in the YouTube Wealth Press channel as well. Or go to rogerscott.com/Telegram. Don't miss out. 1 p.m. Eastern Time, myself, Chuck Hughes, Tuesday the 20th, 1 p.m. Eastern Time, right after VIP room. We're going to head out there. We're going to have a great class today, and we're going to talk about the next capital injection. You guys have a great day. Make sure post comments below this video. Bye.